The US has a big, no, huge problem, and we are going to discuss that today. It comes from two fronts, and we are going to explain why both of these happening at the same time puts the US in a tight spot. You came here for the truth, so let me unveil that for you. In today's video, we're going to look at the United States in a precarious position where they've been doing something for decades and decades, getting away with it. But now things are changing, at least in the short term. And so what I think for everybody, they must pay attention to what I've got to show. We'll begin with this. We're going to look at bonds, and I want to look at the market in general. And the first thing is about the Federal Reserve, because they are certainly front and center. Jefferson says the Fed can proceed carefully, mindful of yields rise. Fed Vice Chair says he's cognizant of the impacts of higher yields. And so at this time, the bond market is signaling, hey, we've got an issue, flashing red lights everywhere. The Federal Reserve is saying, we got it. Don't worry. Of course, the bond market doesn't listen to anything. It just reacts, okay? And so you also see the central bank in a sensitive period managing risks. That is also true here at this time, because we can see this right now, the United States being the most prominent of all, and it needs to maintain focus, but they're having a challenge. So we'll talk more about that. You can see right here that the biggest buyers of the US debt are not buying. And that is the big story for today. We're going to look at that. Imagine you've got a customer, you've got a mom and pop shop, and your regular customer, the one that comes in every day, and that's the, your anchor, because the business can run because you've got these regular customers, and suddenly they don't show up. Uh-oh, now you've got a problem. And the same thing applies to the US government, right? Who's going to step in if that's the case? So if the bigger buyers, the biggest buyers, if your best customer isn't coming and shopping, what do you do and who is going to save you? Can you guess where we're going with this? I'd love to know what you think. Watch the reactions of the banks, because whatever happens with these banks, you might say, who cares about the banks? But you got to understand, that is a bellwether. That is a signal. And so we watch what they do. We watch the Jamie Dimons. We look at the Goldman Sachses, and we try to pull a little bit of information and see what they are doing. And I'll give you some of that information right here in this video. That is what we need to test as a signal for what's to come. Here we have more. America's biggest bond buyers aren't buying bonds. Now, right away, you can definitely see that why that would be an issue. Behind the surge in U.S. government bond yields over the last 6 months is a simple fact. China and the Fed, the two of the biggest players in the market, aren't buying. And of course, that's huge, huge. And so they're basically saying, yeah, China's not doing it, and the Federal Reserve is not buying anymore. In fact, they are part of this quantitative tightening that's taking place right here. What does that mean? It means they are specifically letting their bonds run off. So they had $9 trillion of total balance sheet. And for the treasuries and the mortgage-backed securities, they've been just kind of letting that go. So let's say it was a 1-year treasury. They would just, as it matured, just let it go. Before, what they were doing was buying more. And now they're just kind of letting that mature. And so that means that their balance sheet is starting to decline. When they do that, they're drying up liquidity. Just like you would have your tap. Before, it was run at full blast. So imagine that thing is running at full blast and it's filling up that sink. But now it's kind of going all the way shut. So you might have some water filled into that sink or that tub. It might be there. But what they're doing here is they've shut the tap off, so no additional water's coming in, that currency, that current. And maybe there's a little bit of a leak in there because that's depleting as time goes on. So you see, if we don't have that happening, well, then the banks are the first one to take that hit. Okay, and so we'll see this right here. Over the last year, the Federal Reserve has decreased its holdings by $650 billion. That's just for the treasuries. Okay, so in total, it's approximately about $1 trillion. they go on to talk about China as well. There's issues with China because not everything is public, it's not transparent, and so on. We know that, of course. We got to take everything when it comes to China with a grain of salt. We don't want to necessarily just believe anything face value. And the way that they do things is different than they would do so in the US and so on. Okay, they just give you a little bit more context. I think that is important, but all you need to know for the purposes right here is that the two biggest buyers aren't buying. And if that's the case, who will come in? And if they're not buying, well, then what does it mean for the government? Because the government, they need to spend a lot of money right here. They need to spend a lot of money. And so when they do that, they have to issue bonds. The Treasury does this, and so they'll say, okay, we got all this debt here, and we need to package that up and sell it off to investors. But when they do so, well, then it's a little bit of a challenge if you don't have the buyers coming in to scoop all that up. The US, let's be honest, they've had a monopoly for a very long time. And the reason is simply that they've had this buyer out there being able to come in and buy it all up. But now, at least in the short term, this is changing. So China has been reducing its treasury holdings for years. When you look back on the chart, on average, for many, many, many years, it's been declining. At the same time, more importantly anyway, we've seen the Federal Reserve, while they had been buying up trillions in bonds, they're not doing so anymore. Many have said that the Federal Reserve, and I'm on board with this, the Federal Reserve will have to be the buyer of last resort. And what this means is that you will have some sort of deflationary event that takes place. Maybe some bank failures. It could be anything. And so you have this concern. The government says, we've got to suddenly flood the economy with money. When they do that, they have to issue bonds, and they have to issue those at higher yields to make it more attractive. Because you don't want to buy that debt if it's only giving you 2% when you can get a money market fund, liquid and so on, or short-term debt for 5%, 6% in many cases. So where are you going to go? Are you going to buy a 30-year bond that's giving you a few percent, or are you going to buy the money market, which is giving you 5%? So you see the dilemma that they have. The US government is really in a precarious position right here and now because of this. I hope I've made myself clear. We're going to break it down a little further. If you've appreciated this information so far, hit that thumbs up button. I've got more for you right here and now. The Treasury will have an unusually high amount of gross issuance, like how many bonds they got to issue, which increases rollover risk and sensitivity to future rate changes. So this is Goldman Sachs estimating that. And while we're not in the same position of 2020, all governments are basically doing this. Like you can see roughly that same pattern. Yes, 2020 was a surge in every sense, but now we're on a higher, like the trajectory has gone overboard basically since that point, because they need to pump out more cash from the government, and there's just more debt. The deficits are expanding, and that goes for just about everywhere. And so that's okay if investors are willing to buy that up, but one day they will not, and then you've got a big problem. $17 trillion is in U.S. treasuries dumped by BRICS nations, China, Brazil, Saudi Arabia, in 1 month. 17 trillion. Now I look at that, billion. I'm getting all my zeros mixed up. Understand that we're talking about 1 month, and look at the countries, of course, fluctuating all the time. And you see this as being something that is intentional. The BRICS nations are moving away slowly but surely from the US dollar. They can't get rid of it overnight. It will be years before they get rid of these, if they intend on getting rid of them all. They might not. Of course, they might just have it more balanced. Whereas before it would have been, overwhelmingly US dollars. Now it might be a much more balanced scenario, just like they want with the multipolar world, or what we've been hearing a lot of, the global south. And so I'm seeing that $17 billion worth 1 month. It's something to mention of significance, because it's not just the Fed and China, but of course, those are the ones we need to pay attention to closely. And I just wanted to make it clear, interest payments on the federal debt, look at what has happened just in the last few years. It has skyrocketed. Can you see that? I mean, it's shocking. The run-up in borrowing costs and the deficit is renewing concerns about Washington's fiscal trajectory. Treasury announced in July that it would begin to gradually increase the size of its debt auctions, surprising the market. And some investors now wonder whether the market can easily absorb all the debt. And so you see, when I'm saying this information is coming from the Wall Street Journal. I'm reading it from all of the analysts and what they have to say. And then I just bring that to you. This is a very worrisome scenario for the United States right here at this time. If they can't pay their bills, you got to realize this. If they don't have those investors. They can't pay their bills. And then who has to? It's the Federal Reserve. And when that happens, which it's inevitable at this point, that you will experience the inflation you saw from the beginning of 2020 up until today will seem like nothing compared to where they'll go when they do this. This is something that we absolutely must pay attention to right now. I've made my point. I think it is something that we are going to keep our eyes on. And of course, don't turn away. Understand this. You got it. I'm sure you got the details now. If not, let me know in the comments. And of course, I am going to break it down even further. Just know how significant this plays with the banks and the way that this system is working, where we're so heavily reliant on the banks right now in this time. And of course, this has gone on for a long time, but more now than ever, because the banks have been reliant on these super low interest rates, and we are far off from those today. All right. We have this really quickly. Janet Yellen made a funny comment, just like her, we'll never see a crisis in our lifetime. Well, anyway, Jan, she had talked about the debt cost to GDP ratio being 1%. Don't worry, everybody. It's going to be this really low number. That's all you need to know about this. Basically, it's just not going to happen. All right. What she's saying here would assume a weighted average interest rate of 0.85%. That's what she's basically saying. Do you think the interest rates are anywhere near that today? No. So is she then suggesting that we are going to experience super low interest rates in the near future? What does that say? What does that tell us? Interesting, right? Unless she believes in some miracle growth coming out of the US as well as lower interest rates, something funky is going on, isn't it? I want to know your thoughts on that. What do you think? You got to know what you can do. I've got some things for you right here. Understand your exposure, investments that you have, the company you own or you work for, and dig. Look into those details, understand the connections. Don't sit idly by on that. You got to know, because there's a lot happening, okay? Now is not the time for risk. Seek, so that's number one, looking at, people just going all, I'm going to invest in this new thing that's, I have no idea what it's all about, and I'm just going to put a whole bunch of cash in there. Now's not the time for that. You do that risk on mentality when they're pumping out the cash. That's when we get stupid. Okay? Not now. You can invest in solid companies. You can invest in real assets, but now, not the time for the wild stuff. All right? And seek fear as a business opportunity, because a lot of the big businesses are going to be shying away from all these things, and it's going to allow an opportunity to come forth. Okay? So be mindful of that. Don't hold long dated debt from any entity, anything, whether that's a corporation, whether that is a sovereign nation's debt, the US, Germany, wherever. Don't hold the long stuff. It's not good right now. You want to be in the shortest as possible so that you can turn that over. You're getting the better yields anyway at this time, and we just don't know what's going to happen. So watch that. Real good stuff right here. Of course, if you want, this is something to check out. If you want to be able to be a better investor right now, because we're in these precarious times, Seeking Alpha can help you do that. And that's why I partnered with them. Just taking a look right here. This is the page, link in the description, where you get the 7-day free trial and the $50 off. As of this recording, it is still on. So definitely check that out. Click the link. You'll be brought to this page. You can get the points. This is what Seeking Alpha Premium. I'm talking about premium, not the stuff you see on, you see these articles on their main site. That's just to get you into the paid stuff. This is what the paid stuff looks like. And then you go in and you'll be able to see that trending analysis, trending news. If you're part of the Alpha Picks, then they will give you the webinars and stuff through that. Good stuff. Anyway, check it out. Link in the description if you're interested. And of course, the comment of the day. Love the comments. Love your comments of the day as well. I always want to highlight one if I can. What's worse than just higher prices is that the quality of things like food and restaurants has diminished completely. Service is non-existent. It's so much better to eat at home now. And that's the truth. That's what a lot of people are saying, they're experiencing. They don't have the desire to go out as much as they did before, and that slows the economy down. This is, of course, what higher interest rates will do, and now we're seeing it front and center. I know you're probably seeing it if you are at the restaurants, the coffee shops, other places. Please let us know in the comments. Let's share. I'd really like to know what you are seeing. All right, that's it for this video. I hope you appreciated it. I'll see you on the next one. Take care.